America's safest asset is quietly being abandoned. That sentence should not make sense. U.S. Treasury bonds are supposed to be the backbone of the global financial system. They're treated like cash. They're treated like certainty. And yet, according to this material, foreign buyers are no longer stepping in to buy 30-year U.S. bonds. That contradiction is the story. And it matters to you because this entire system runs on one assumption, that someone will always lend the United States money. Now, here's the pressure point. In 2026, roughly $10 trillion worth of U.S. bonds mature. When a bond matures, the holder has two choices: roll it over and keep collecting interest, or ask for the cash back. This time, that choice isn't theoretical. If too many people choose door number 2, the math changes fast. Notice what makes this different. The debt isn't just large, it's accelerating. The number in this material is stark. About $1 trillion added every 75 days, and in recent bond auctions, the claim is that there were no foreign buyers at all. So the system did something it almost never talks about. It leaned on primary dealers, big banks that are legally obligated to step in when nobody else does. But here's the part nobody says out loud. If banks are forced buyers and yields have to rise to make that happen, who is actually carrying the risk now? Because when the market stops choosing freely and starts complying by obligation, that's when stability turns into appearance. This is being described as a financial cliff. $10 trillion approaching maturity, fewer willing buyers, more pressure behind the scenes, and the closer we get to 2026, the more this stops looking like normal debt management and starts looking like a test the system has never had to pass before. And the real question isn't whether the wall exists, it's what happens the moment we reach it. What's happening here didn't appear overnight, and it isn't an isolated auction glitch. The material frames this as part of a much larger pattern that's been quietly building. We've been talking about financial stress in places like the United Kingdom, France, and Germany. But the uncomfortable question is this: what if the country with the largest debt load is facing a version of the same problem, just on a much bigger scale? Here's what we know from the content. The United States carries the biggest debt burden in the world, and a massive portion of that debt is marketable treasuries that have to be constantly refinanced. In 2025 alone, around 30% of all U.S. marketable debt, roughly $9.2 trillion plus new deficits, is coming due. And looming right behind that is the 2026 wall, where $10 trillion reaches maturity. This isn't about new spending. This is about old promises coming back for renewal. Now watch how the framing shifts. Normally when treasuries mature, the system assumes most holders will simply roll them over. That assumption only works if confidence is intact and demand is deep. But according to this material, foreign countries are no longer stepping up the way they used to, especially for long-dated bonds like the 30-year. That forces the burden inward onto domestic banks and institutions that don't have the option to say no. And this raises a reframing question that almost never gets asked out loud. If a market only clears because participants are legally required to buy, is that still a market signal, or is it a support mechanism pretending to be one? Because once that line blurs, price no longer reflects confidence. It reflects necessity. This is where the story widens. The issue isn't just whether the U.S. can refinance $10 trillion. It's whether the global system still wants to help carry that load voluntarily, or whether the entire weight is being shifted onto a smaller and smaller group behind closed doors. And once that shift starts, it rarely stays contained. There's a moment in this material where theory collides with a concrete event. In a recent U.S. Treasury auction, the claim is simple and unsettling. There were no buyers, not weak demand, not low participation. Nobody stepped in. When that happens, the system doesn't stop. It flips a switch. Primary dealers, large banks like JP Morgan, are obligated by law to buy the bonds. That's the fact. And it comes with a detail that changes how you read it. The yields went up, which means the interest rate demanded by these forced buyers increased. In plain terms, the bonds didn't become safer or more attractive. They had to be sweetened just to get absorbed. That's not confidence, that's compensation. Here's why that matters. Normally, higher yield signals strong demand balancing risk. But in this case, the higher yield is attached to obligation, not choice. Notice what's missing here. There's no mention of foreign institutions stepping back in once rates rose. The traditional fix didn't work, so the burden stayed inside the system. Now look at the implication carefully. If 80 to 90% of these maturing bonds are already held by major banks, and those same banks are also the buyers of last resort, the question becomes unavoidable. Are they actually paying new money, or are they just rolling paper in a closed loop? This is where the story flips. Because when unsold treasuries are quietly absorbed and masked through internal mechanisms, the signal the market would normally send never reaches the surface. Stability is preserved. Transparency is not. And once the system starts hiding stress instead of resolving it, pressure doesn't disappear. It accumulates. The pressure intensifies when you widen the lens beyond U.S. auctions. The material points to a second signal, and it's harder to ignore. Major foreign holders aren't just slowing purchases. Some are actively exiting. One concrete example given is the Reserve Bank of India, which reportedly dumped around $50 billion in U.S. treasuries to aggressively accumulate gold. That's a fact from the content. And here's what it implies. Central banks don't make moves like that for short-term trades. They move when trust, incentives, or risk calculations change. At the same time, the material notes that BRICS nations are pivoting toward gold as a reserve asset, shifting away from treasuries that once anchored global reserves. Now, notice the contradiction. The US dollar is still described as the #1 reserve currency, with gold sitting at #2. Day to day, nothing looks broken. Exchange rates still function. Transactions still clear. But beneath that surface, reserve behavior is quietly changing. This is the line that permanently alters how you see the situation. If the dollar remains dominant, but treasuries are losing foreign demand, then the currency and the debt backing it are starting to diverge. That's not collapse. It's decoupling, and decoupling creates a new problem. If foreign central banks are no longer the backstop and domestic banks are already saturated, the system has to find a different way to fund itself without triggering panic. That's when unconventional solutions start to appear. Once conventional demand weakens, the system doesn't announce it. It adapts, quietly. The material suggests that this is exactly what's happening now. To prevent what's described as a sovereign debt spiral, the Trump administration is reportedly exploring alternative funding paths that would have sounded unthinkable not long ago. Federal land sales, a strategic Bitcoin reserve, ideas designed not to grow the economy but to buy time. At the same moment, another lever is being prepared, yield curve control. That's the Federal Reserve stepping in to cap interest rates, keeping borrowing costs artificially low, even if demand doesn't justify it. The goal is clear: slow the velocity of debt growth, reduce the interest burden, and keep refinancing possible. But here's the catch buried in the details. Lower rates help the borrower, not the lender. This is where the tension sharpens. If yields are capped while inflation and risk perceptions rise, bondholders are effectively asked to accept less in real terms. That's not a default on paper. But economically, it's dilution. And dilution doesn't require a crisis headline. It happens gradually, quietly, while the system insists nothing is wrong. Notice what this enables. The government keeps functioning, auctions keep clearing, markets stay open, but the price of stability is pushed onto holders of dollars and bonds through reduced purchasing power. That's why the material raises the question of devaluation, not against other currencies, but against commodities like gold and silver. And once a system starts choosing between visible panic and invisible erosion, history suggests it almost always chooses erosion. When pressure builds like this, it rarely stays isolated to one lever. The material stacks several developments that on their own might seem manageable, but together feel destabilizing. Debt continues to accumulate at roughly $1 trillion every 75 days. Massive maturities are clustering into a short time window. Foreign demand is fading right when refinancing needs peak. There's no pause between these events. They overlap, and that's the danger. When refinancing rising debt and weakening demand hit at the same time, the system loses room to maneuver. Every option carries a cost. Raise rates and the interest bill explodes. Cap rates and bondholders quietly lose value. Force banks to absorb more debt and risk concentrates inside the financial core. This is the mini crisis stack. None of these moves trigger an emergency alone. Together, they compress time. Decisions that once unfolded over years now have to be made in months. And when speed replaces deliberation, mistakes compound. Here's the unsettling part. The system is still functioning precisely because these pressures are being managed, deferred, and redirected. But deferral only works if confidence holds. And confidence, once cracked, doesn't erode slowly. It snaps. At this point, it stops being abstract and starts touching real life. Because when systems manage stress this way, the effects don't arrive as a single crash. They show up in everyday decisions that feel disconnected until they aren't. If you move money across borders, the material raises an uncomfortable question. Is the dollar holding steady, or is it quietly losing value against real assets? On paper, exchange rates still look normal, but against gold and silver, purchasing power has already slipped. That gap matters if you're saving, exporting, importing, or planning years ahead instead of weeks. Lower yields means savings earn less. Higher hidden inflation means costs rise without headlines. Businesses dealing in foreign trade are forced to guess whether today's stability survives tomorrow. And because none of this feels like a crisis, most people don't adjust until the adjustment is forced. That's why this phase feels muddy. Nothing is clearly broken. Nothing is clearly safe. The rules feel like they're shifting under the surface while public messaging stays calm and procedural. This is where the story gets smarter than the headlines. What allows a situation like this to persist isn't denial, it's design. The system is built to absorb stress without showing it. Obligations replace choice, coordination replaces confidence, signals are softened before they reach the public. But here's the uncomfortable insight. When stability depends on obligation instead of belief, the system becomes sensitive to timing, narrative, and trust. Small disruptions matter more. Optionality becomes valuable. That's why alternatives like gold, stablecoins, and Bitcoin even enter the conversation, not because they're perfect, but because they exist outside the closed loop. From here, the path forward splits. One path is controlled continuation. Rates are capped. Banks absorb more debt. Confidence is maintained just long enough to roll obligations forward again. Nothing dramatic happens until it does. The other path is disorderly adjustment. A small failure lands at the wrong moment. A foreign seller accelerates. A political constraint limits intervention. And suddenly the mechanisms designed to hide stress are forced into the open. Neither outcome requires catastrophe. Both depend on belief. Here's the insight that ties everything together. This story isn't about bonds. It's about what happens when a system built on voluntary trust starts relying on enforced participation. When buyers choose freely, prices tell the truth. When buyers are compelled, prices tell a story of survival. Reframe it in one sentence. The United States isn't running out of money. It's running out of willing buyers for long-term promises. And that changes everything. If you want to keep tracking what forms beneath the headlines, stay with this analysis. Because the next phase won't begin with a crash. It will begin with a decision you won't see announced. And by the time it's visible, the story will already be moving on.